Welcome to Hargreaves Lansdown's Meet the Manager. I'm Joseph Hill, and today I'm joined by Ian McCombie, co-manager of the Baillie Gifford Managed Fund, which features on our Wealth shortlist of funds selected for their performance potential. So Ian, the Baillie Gifford Managed Fund can invest across shares, bonds and cash. So where are you finding the most attractive opportunities at the moment?
Well, Joe, what we have is about 75% in benchmark is in equities and 25% is in bonds and cash. So as you can see, we generally like equities. And at the moment, we're slightly overweight in equities. And the way we do this, Joe, is we use it from our bottom-up basis. So our fund managers from our different regional teams come together and say, well, are they positive or negative on their portfolio? So actually, we are overweight in equities, which means that we like what we're finding in our bottom-up portfolios. Now, I should say that actually that's come down a little bit from where we were perhaps 6 months ago, and that's because actually we've had very strong absolute performance, particularly from a couple of our regions, including the US, and we've taken a little bit of money out of that. So that's where we're kind of finding, in terms of our portfolio. But on an individual level, we're finding still, despite all the kind of macro, the top-down that people are talking about, the individual companies, we're still finding really exciting opportunities. So, for example, I cover the UK market, and for example, we own Games Workshop, which is doing fantastically well. It's got fantastic IP, and people are still buying their products, and they've signed up a deal with Amazon, which is really exciting. And we've got something like Auto Trader, which is a multiple of the size of its number two player, almost 14 times bigger than the number two player, roughly speaking. And that's a tremendous position to be in, and they've got a great opportunity there to grow. So, we're still finding great opportunities to invest in.
And you talked about the fund's sort of top-down positioning there. It has tended to have that equity bias through history, typically between 65 and 85% of the fund invested in the stock market at any one time. So could you expand on that? Why have that equity bias, and how do you decide what the right amount is to have invested in the stock market?
Yeah, it's very important. What we're trying to do with this fund is to grow our clients' capital. So we think the best way to do that is having a very strong weighting in equities. So roughly speaking, as I said, the neutral one would be about 75%. But as you say, you could go up to either 85 or down to 65. But we're always going to have a strong equity weighting. Now, the reason for that is very simple. We think to get that growth, equities is the best way to get that. Never forget the fact that equities are a warrant on human ingenuity, and that's why we're always going to have that opportunity set of wanting to invest in equities. Now, the bonds and the cash bring balance to that. That we appreciate the fact that equities are volatile in the short term, and that can sometimes unnerve people. But the reason why we have a managed fund is to have that balance, so having 25% of the portfolio in less volatile bonds and cash brings that balance and also provides a bit more income too.
And touching on the fixed income part of the portfolio as well, corporate bonds are looking quite expensive at the moment relative to their history. So how is that part of the portfolio positioned at the moment?
Well, I think what we would say is that I think the bonds are positioned that there's a little margin for error rather than they're overvalued. We think that actually some of the fundamentals for bonds are actually not bad at the moment. We're seeing decent economic growth globally. Inflation has come down a bit, and actually the defaults are very low. So actually it's not all bad news. And if you're an individual bond picker like we are still finding those opportunities. But that said, you're right, that valuations have done well. And actually what we've done is we've taken some money out of our high yield bit of the bond market. And we've also invested a bit more in our government bond market. So we're pretty neutral. We've also reduced the duration a little bit. So we're not disagreeing with you completely, but we still think there is value in the bond market.
And thinking back to the start of your career, Ian, interested in any tips you've picked up along the way that might have been useful to know back when you started out?
Oh, I could go on for hours, not Joe, on that one. I think one that's really important for me, particularly as a growth investor, is if you can find a really good growth business, don't underestimate the power of compounding, because I think when I was younger, I didn't always appreciate the fact that a great business might look very expensive on a short-term rating, the next couple of years. But if it can keep growing at that very strong rate of growth for 5, 10, 15, 20 years, it could actually be very, very cheap. So that was one of the big lessons I had to learn.
And who would you say has had the biggest influence on you as an investor?
Well, one of the benefits, Joe, of actually being in one firm for 30 plus years, which I have been at Baillie Gifford, is you learn a huge amount from the people you work with at the firm. That's the longevity of staff at Baillie Gifford, I think is really is a huge advantage. So the fact that you learn together, you learn from your colleagues, I think has been huge. But in terms of external people that have influenced me, I think one of the great books I've ever read on investment is the one Poor Charlie's Almanac, which is written by Charlie Munger, who was, till he died recently, Warren Buffett's number 2, effectively. And I think it's a great book, because it's not really about investment per se, it's about how you think about problems and trying to think about it as broadly as possible. And I would always recommend that as a great book for people to kind of help you think about how you try and navigate investment. So just actually kind of think about it almost obliquely, which I think is really important.
And outside of work, how do you switch off?
Oh well, how do you ever switch off? Well, I run, I do hill walking, I walk my dog, and I suppose I also watch Scotland rugby, but you can't really switch off watching Scotland rugby anyway.
Great, Ian, thank you very much for joining us.
Thank you.